people are looking at the price action last week between markets and volatility and saying, VIX completely underreacted, right? VIX is broken again. I don't think so. I actually think the move was very healthy, but also very warranted given the kind of prevailing macro environment. I think a lot of investors have recency bias with respect to what happened on August 5th of last year, even December FOMC last year. But in those instances, the market had set itself up for failure with respect to investors being much less defensively positioned. Index hedging was kind of out the window. Heading into the macro boiling over, since the start of the year, investors were more defensively positioned. Dealers were relatively longer gamma, so they were kind of keeping.
What's gamma?
So when we talk about gamma, sorry to get into a little bit into the weeds. What we've been talking about is, given the options activity from investors, both on the put side and the call side, given that demand for index protection had waned, investors are buying less puts. That leaves dealers and market makers less short those puts, right? So when the market sells off, how much do dealers and market makers have to sell into that, adding fuel to the fire? That exposure was much less sort of heading into this macro boiling over.
Do you realize somebody just drove off the road on I-81 near Carbondale? Exactly. I mean, the Greek letters, it's too much as well. What's a mere mortal do right now with the oddities of the market, with gamma out of whack, delta, alpha, beta, vega, OMG, the theta? Our audience doesn't get the Greek letters, but what do the Greek letters say now about how our expectations have changed?
So right now, we think this is more fundamental, actually. It's less Greeky, if you will. We believe this is a fundamental re-rating higher in volatility, given the prevailing macro environment.
So if the VIX nirvana is 12, 13, 14, what's the new nirvana? 18?
Our models, but also our intuition tells us 20 to 25 is probably fair.
20 is the new...
20 is the new 12.
20 is the new, that's a headline.
Yeah. 20 is the new 12.
20 is the new 12?
Yeah, that's what our models tell us.
Let me cut to the Rich Sweeney's going to ask it. Should we then go to cash?
So it's very interesting, and this is what we've been studying over the last several weeks with respect to not just rotation under the surface within the U.S., but rotation globally, right, into Europe, into China, out of the U.S., right? If an investor is long U.S. equities and they sense fear, they can buy a put to hedge themselves, right? You buy a put, the price of put protection goes up, skew blows out, VIX blows out, right? That's kind of what you saw heading into August 5th. Now, it's a little different. Investors are actually reducing U.S. equity exposure. They're not necessarily hedging that exposure, they're reducing equity exposure. That's their hedge, right? And rotating into other regions like Europe and China, right? That's not a volatility event. That's a market downturn event, which is kind of what you've seen. Nevertheless, S&P down, peak to trough, down 10%, VIX up 13 or 14 points. That's still a very healthy move. Again, I think people were looking at August 5th and expecting this massive volatility reaction. Like I said, the market was not set up for that.